It's almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Most Asian shares rising along with U.S. futures as investors position for the quarter end and a key U.S. inflation reading. China's central bank reinforcing support for the yuan by raising its daily reference rate the most since January. Boeing's customers finally have what they've been after, a leadership shakeup. We discuss whether this can restore confidence. And a great lineup of guests ahead, starting with Deutsche Private Bank's APAC CIO with a market outlook. Later, from the Milken Institute Global Investor Symposium, we'll be joined by Hill House partner Siddhartha Hari on the hottest private markets for 2024. Now let's do a check-in on markets. Avril Hong is standing by. Avril, Asia pretty much eking out some gains, but not much conviction.
Not much conviction, but still I think it has to be said that it's brushing aside in the way, right, that hawkish Fed speak from Bostic reiterating that, we might only see one cut from the Fed this year. We're seeing US futures, treasuries, Asia stock gauge all ticking higher as there seems to be some certainty returning to the markets. The PBOC today ramping up support for the Chinese currency via the fix after spooking markets on Friday, yet worth highlighting here onshore, we're still seeing that weakness, and yuan bears don't seem terribly convinced. On the Japanese currency, we've been seeing it moving in relatively tight ranges to the greenback as all this intervention chatter really helps to put a floor under the Japanese yen. But there are some bright spots, I think, today, and the Kospi rising to roughly 2-year highs is really helped along by the chip sector. So not that much conviction, but we do still see some of those rises.
And after that massive rally in the US, some are saying perhaps too much, too fast, and perhaps it's time to reposition.
Maybe position to Japan. If you take a look at the way the topics has been outperforming versus the S&P 500, it's run up about 17% so far this year versus the S&P 500's 10%. A lot of this has to do with the idea that we're seeing signs of deflation coming to an end, economic revival, the yen is cheap. But if you also look and take a step back, there are some who think that the BOJ could raise rates later this year. That could put pressure on the export-related stocks. But I think most analysts would still agree that we could still see the outperformance of Japanese equities because as wages rise, you could see purchasing power improving, and that could be good for domestic related stocks, and that could form a bit of a rotation. And don't forget, for the US equities, a lot of it has got to do with whether we see profit acceleration, to kind of justify these lofty valuations. And that's going to be very dependent on what we get on rate cuts, Has.
So Japan coming to the fore. Avril Hong, thank you. In the battle of Japanese versus US stocks, which market will outperform from here? Let's bring in Stephanie Holtze-Jen, APAC CIO at Deutsche Private Bank, who has Japan as one of her top conviction calls. So, further to run for the Nikkei 225.
Yes.
Why?
Well, I don't think I'm adding anything new in terms of explaining the whole structural elements that are benefiting the markets. But I think what we have understood just as a market reaction after the Bank of Japan is that all these cyclical elements also stay in place. And I think the Bank of Japan has maneuvered this rate hike out of negative interest rate territory very cleverly, because they have informed that at the same time they will stay very accommodative. They are now the one central bank that is still doing QE. And as a reaction function, we have not seen the yen strengthening. We have seen it continue its path of weakening. And this has been a further tailwind for equities to go higher. So I think in the short term, it's very difficult to see what will derail the ability of Japanese equities to outperform even US equities.
So how do you position in Japan? What do you buy? Some say perhaps real estate is a good one.
No, we are actually, not to say no, but actually we have 3 very specific sector calls. One is around consumer discretionary. I think it was just mentioned before with the wage hikes, that will add a lot of, real spending power into the consumers' pockets. We are also looking at the semiconductor space, IT, on that end. And Yeah, so these are, I think, the very most important ones to go after. Financials is a very obvious one because the banks will now be in a different territory with rates being moved out of negative interest rate territory.
We are keeping a very close eye on the yen. We have Kanda saying that, you know what, a weak yen right now is not good for the economy. The benefits have gone. Where do you see the yen headed? I mean, and when do you see intervention? Some say 152.
Yes. And obviously we get the heaviest verbal intervention that we got for a while now, that we're approaching this 152 level, which was intervention level last time around. But I've been arguing, all these time that the weak yen is a double-edged sword. Yes, we've been informed that we do not want to have speculation in the market. They do not want to see the yen weaken too much. But on the other hand, it's benefiting an export-led economy. So it fuels that equity market drive. So I think it will be very difficult for the Bank of Japan, of the Ministry of Finance, to go in with real kind of power and intervene at these levels. So I think we see a gradual depreciation happening, and as long as it's gradual, it most probably will be allowed. But it's very difficult to see with this interest rate differential between the US and Japan to really change around the dynamic around it.
The thing is, the narrative around USD exceptionalism isn't likely to change, right? We had Bostic saying, you know what, possibly only one rate cut this year. So what will happen to the yen then? Is it on a downward trajectory towards year end?
Well, I don't think it will just be on one-way street. I think we have already seen the officials are trying to dampen this move. It will be a very gradual trajectory. But you're talking about the US dollar benefiting on the back of possibly the Fed unwinding that
at a slower pace,
the market's idea of rate cuts. And you see, we have started the year with 7 rate cuts being priced in, and now we moved to 3 rate cuts because that's what the Fed told us last year. By the way, we've just moved this for this year to 2 cuts only. Now you mentioned Bostic talking about only 1, but I don't think the US dollar is only informed just because of that. I don't think we've seen a huge beneficial rally for the US dollar on the back of these rate cut expectations being repriced. I think there's more elements to it, but of course it puts a lid on a depreciation path for the US dollar, which many had foreseen start into this year. Not us, though.
Speaking of repricing, you've cut your projection from 3 rate cuts for the year to 2.
Correct.
What would it take for you to reassess and cut it again to 1 in line with Bostic?
Well, we have already been non-consensus for a long time. So last year, for instance, we were the only bank not calling for any rate cut. We started the year when everybody was pricing in 7, was saying we are at 3. And just 2 weeks ago, we decided that now that we're forecasting a year ahead into March 2025, we stick to 3, but we move 1 cut into the first quarter of next year. Reason being that the Fed is operating from such a strong backdrop that they can actually afford to go every other meeting and maybe do not want to be seen too close to the election time. So I don't think there needs to be much more to change that. It's very realistic because the Fed has put in the pivot. They need to start very soon, and then leaving a gap between June and first quarter, I think, is too long. So 2 is very good.
Valuations remain elevated, especially in the US. It would take rate cuts to justify those valuations.
Well, we have seen, despite no rate cuts but a rate hike cycle, these valuations to be lofty and the market going up. So of course, more rate cuts could help, but even the repricing, again, I don't think has derailed the overall structural story that's in place for higher U.S. equities. So again, I don't think that's the only information and reaction function that there is. But of course, that would be one.
Our M Live colleagues are asking the question when the S&P will get to 6,000.
Oh, that's the
Your
new
thoughts
target.
on that?
Well, our target for in 1 year's time is at 5,300. So 6,000 is very lofty. And, as you know, every other year there should be a market correction, meaning, a 10% correction. I could argue maybe we go 6,000 and then correct to 5,300, but I think we don't want to construct anything around some lofty numbers being put in place. It doesn't look like that we need to go to that extent, but a slow upward trajectory with the ability to correct and going in at better level, that is something that we will see for the year ahead.
I want to talk about the bond market and the yield curve. We're seeing 2 and 10s inverted for the longest period ever. I mean, traditionally, this is a sign that a recession is coming, but so far, no obvious sign of contraction in the U.S. economy. How are you reading that, and how do you position in the bond market?
Yes, we also see the bond market to come to a more normal level anytime soon. I'm likewise waiting for that inversion to be priced out, and I think we're getting close to that, because I think right now we are starting, we are in the process of assessing when will this first rate cut start, and I think once that starts, that is the time when we get to more of a normalized rate environment, because then again we have that look ahead as to more rate cuts in the future.
Is it time to think about neutral rate, or is that still a difficult question to answer?
A very difficult question to answer.
All right, well, leave it there. Of course, Stephanie will be sticking around. Stephanie Holtze-Jen, Deutsche Bank Private Bank, is sticking around. Still ahead this hour, we discuss whether China's private credit market will make a comeback this year or whether India will be in the spotlight. Hill House partner Siddhartha Hari will be joining us ahead. Keep it here with us. This is Bloomberg. Let's take a look at how Chinese stocks are faring at this point in time. We have the Shanghai Comp now reversing its gains, now down 0.3%. The Hang Seng and the HS Tech in positive territory, but reversing some of those gains we saw earlier in the morning as well. That's despite PBOC Governor Pan Gongsheng saying that he sees positive signals in China's property market. He says has solid foundation for long-term development, not allaying those concerns in the property sector. We have CSI 300 index now flat on the day. The yuan trading at 721.75 at this point in time. Of course, on the back of that elevated, stronger than anticipated fix, which we saw from the PBOC. Now, Chinese stocks have been soothing investors' nerves as of late, bouncing back from recent lows at the start of the year. The latest activity data for the first 2 months of the year showing the first tentative signs of recovery. Let's bring back Stephanie Holtze-Jen, Apex CIO at Deutsche Bank Private Bank. Well, you had an overweight not too long ago. Now you're pretty cautious. That's pretty short span of time.
We can also be tactical. We have to make money for clients, of course. But so overall, China, we always looked at it as a second half opportunity. But I thought about a month ago, a little bit more than that, we reached a time where that was almost an inflection point in terms of negativity. And we saw, how the government was propping up a lot of measures that seemed to kind of help prop up the market. Now I'm getting more cautious now because of what happened on Friday. We saw the currency being allowed to weaken with the lower fixing, and I thought it was a litmus test for sentiment, really, because my initial reaction was when I saw that, it's like, wow, this is good, because this displays confidence on the side of PBOC to be able to weaken the currency, because it's some form of monetary stimulus that you can bring in at a time where the Fed is just informed. Obviously they will not move rates right now, but if the PBOC would move ahead, lowering rates ahead of the Fed, that would have an information on the currency weakening and then possibly have a vicious cycle. So, tackling the currency was something I thought was quite credible, but the market didn't take it at all like that. So the immediate reaction function was for the equities market to sell off. I think they didn't like that volatility that I thought was actually a positive to be injected and allowed by the PBOC. And so they didn't like this instability, and it was immediately negatively interpreted, and we had this big sell-off on Friday. And for me, this is a sign that sentiment has still not stabilized. So on a technical basis, again, I think we have profited from what there was in terms of building a base and ending up in the green for the year.
But the thing is,
that's it for now.
The signaling, the messaging from China has been pretty positive. We have, the PBOC saying triple R cuts are coming. Yes. We are also seeing the government saying more support for the property sector is coming.
Yes.
Why is that not enough?
And also, I think I was especially happy last week because I thought the macroeconomic data was actually coming in not too bad. So I always look at these three parts: sentiment, then the flows, and the macroeconomic data. To me, when sentiment's looked like it stabilized. Flow was coming our way. What was missing was the macroeconomic data, and it looked like it picked up a little bit. It wasn't too ambitious, but it was the period after Lunar New Year that was quite important to see, because it would have been a normalizing data set. And I was looking ahead into this week, looking forward to this week's data, also PMI perhaps coming back to 50, etc. But then again, I thought this derailed when we saw what happened in the currency. So despite all the messaging, despite the data coming in as well, it's not the time yet. And I think it's important to listen to the market. If there's not enough confidence, not enough sentiment that is turned positive, it's better to just go to the sidelines for tactical.
If you listen to the market, they're saying perhaps it is time to get out of India and put your money into China. Is that what you're thinking as well?
I monitor Japan, India, and China triangle very closely, because there's been a lot of notion that the outflows from China went into India and Japan, because at the same time that China did not perform, we saw these two markets outperform. So I think we need to be very careful in understanding, is the flow now that is coming into China taken from India or from Japan? What's the market that could correct the first? Because both are going into overvalued territory. And from what I saw from the flow data, sticking with the facts, is that the Asian ADR flows show that this money is coming out of India at the moment, not so much from Japan. And I think the reason is that Japan is very much also driven by domestic sales. So whatever happens in geopolitics doesn't so much affect it. So that makes intuitive sense. So, but I right now I monitor India for that kind of flow dynamic. Are
you concerned about regulatory warnings from the regulators, the clampdown we're seeing from SEBI, for instance? Is that a sign for you to perhaps be cautious in the Indian market?
The Indian market, we have to be cautious for sure on the small and mid-cap sector, but we feel still comfortable with the large caps.
Yeah. And in terms of risk perhaps from the election that's coming up?
That is a very good one. We looked at the last 5 elections, how the market reacted back then, and you look at the 6 months after the election, the market on average made 21%. You look at the 6 months before, the market made about 12% on average, and only on election day there was actually 2 occasions where we had a sell-off happening and only made 2% on average. So it looks like a lot gets priced in before. Once the uncertainty is out, maybe on election day you have a bit of, okay, now you get the news, sell effect, but then afterwards we go back to be able to perform. And I think the outcome that we expect is more stability and more of the same policies to benefit India. So in that respect, I fully believe that you can draw into the future from history.
Stephanie, people are not talking about gold, but gold hitting new record highs.
Yes.
I mean, what are you reading into that? And will you be pumping more money into gold?
Gold is a big call for us. Already it's been since November last year. We had a gold target put at 2,250 for the year ahead. We've just revised that up to 2,400. I know we got a bit of a, people smiling at us when we did it initially, and now everyone is revising up their targets. I think the drivers for gold are very valid and very strong. So you have all the ones that we know about. This part of the world is heavily investing in gold. We have central bank diversification. We have geopolitics at play. We may have interest rate cuts coming our way that is removing a headwind for gold. At the other hand, even if inflation is higher, gold is also benefiting. But on top of that, I think the big driver this year is really also the Chinese retail investor moving into gold. And I think a setup where you have a weakening currency, possibly still the property market weighing, it can be very well understood that a store of value is not just for the central bank, but also for the, for investors, a gold play.
Not to mention demand in India as well. Stephanie,
Absolutely.
Thank you. Stephanie Holtze-Jen, Deutsche Bank Private Bank. Well, still to come, Boeing announces a leadership shakeup after a customer revolt over its spiraling safety crisis. Details just ahead. This is Bloomberg. Welcome back. Boeing shares closed higher after top executives, including CEO Dave Calhoun, announced their departures. The high-profile exits come after a near-catastrophic incident in January involving a 737 MAX. Calhoun's predecessor, Dennis Muilenburg, was fired in 2019 after two MAX jet crashes killed 346 people. For more, let's bring in Bloomberg Asia tech opinion columnist Tim Kalpin. Tim, the shakeup hardly surprising. The question really is whether this marks the end of their problems, and my guess is it doesn't.
No, it really it marks the next step. It's the start of the next set of problems. I mean, I think the fact that the Boeing shares climbed tells you a lot about how investors feel about this move. It needed to be made. Interesting, the CEO gets to stay on until the end of the year. That's a little bit of a worry for many people. And so I think that's something that people will be watching very, very closely. I personally wouldn't be surprised if he does actually end up exiting before the end of the year. Of course, Boeing and its board, with a new chairman, Stephen Mollenkopf, who previously ran Qualcomm, will be wanting to replace that role as quickly as possible. But of course, they have to find the right person, because the last person brought in to fix the problems is the one who's just departing. So there's a lot of problems ahead for Boeing to fix, but replacing its top management is the first step to fixing those problems.
You're right, succession is a problem. Few people are qualified. So where do we go from here? How does Boeing fix this problem, perhaps once and for all?
Well, I mean, the fact that the board is also changing with, a new chairman coming in, I think should be a good step. Boeing's board, you can see in the last kind of couple of weeks, has not been passive. Airline customers actually went to the board directly and asked them to replace the leadership. So the board was the one that really made this move. And so I think it's going to be the board's job to set up the right kind of environment, the right kind of culture. And so whenever that new CEO does come in, hopefully sooner rather than later, the ideas and kind of what is required will be really laid out, because as the board brings in a new CEO, they will be trying to work out whether this CEO matches the kind of culture they need to create and build from scratch at Boeing.
Tim, setback after setback for Boeing. You gotta wonder how it will now compete with Airbus. What will that take?
Well, Airbus is being very, very careful about this. There is basically a duopoly between Airbus and Boeing, but you don't really hear Airbus crowing about it because, aviation safety is something that everybody takes seriously. When one airline suffers a crash, you don't tend to hear the CEO of another airline crowing about their safety record. So Airbus is doing all the right things, basically staying very, very quiet, putting their heads down, getting to work building and selling planes. And of course, the Chinese have COMAC coming in, and they maybe over the next few years will try to use the problems of Boeing to try and create the idea amongst especially smaller airlines that perhaps the Chinese are a viable alternative to consider.
Tim, thank you so much for that. Good to see you again. Bloomberg Asia Tech opinion columnist Tim Kalpin there. Let's get you to market. Take a look at some of those chip-related stocks with SK Hynix in Korea. Its market cap nearing $100 billion. What a run for SK Hynix. They're up by 5.5% at this point in time. Samsung Electronics surging as well, currently up by about 2%. Of course, that's on the back of the Micron rally, which we saw overnight hitting its day 7 because of those post-earnings climb that we're seeing. Flip the page, take a look at where we are in terms of some of those resources plays as well as developers. Shimao Property currently up by 4%. China Resources up 2.5%. Of course, when it comes to China Property, we've heard from PBOC Governor Pan Gongshang saying he sees positive signals in China's property market, which he says has solid foundation for long-term development. And in terms of the overall market, Asia eking out some gains despite the fact that we saw the S&P close in the negative. Plenty more ahead. Keep it here with us. This is Bloomberg. Back from from lunch break in Japan. Let's do a check on how everything is doing. Avril Hong, of course, standing by. Avril.
Yeah, let's take a look at how Japan is faring on the Nikkei. We've seen how it's been trailing the Asian equity space for much of the session. I think there's the idea that as we see the dynamics from the yen come through, that's in a way putting a cap on what we're seeing on Japanese equities. Also has to be said that one of the key drags on the Nikkei today, automaker Nissan, as it unveiled its plans that it wants to sell an additional 1 million vehicles in the next 3 years. It wants to come up with about 30 more new models, about half of these electrified. This has been described by analysts as an aggressive plan. They don't seem to like the strategy that Nissan is pushing through, and its stock is actually tanking or slipping by the most in about 6 weeks. So that is the key drag we're seeing in Japan today. Flip the board. Let's take a look cross assets. I think that's also where you see how Japan seems to be trailing, quite cautious on bonds. Topics also flat today.
Avril, I want to talk about commodities. Here's one thing we don't normally talk about. Cocoa, now more expensive than copper. What's the story there?
We don't talk about it on air, but you and I talk about it fairly often with chocolate off air. The story there is supply. Though I think you are single-handedly lifting demand for cocoa, we're seeing how on the supply front, things have been really tight because of what's happening in West Africa, whether you're talking about lack of fertilizers, disease. So those are issues that are constraining supply, particularly in Ivory Coast and in Ghana. And we actually saw this trigger coming in the form of word on the street that Ghana was going to lose access to a key funding facility. Basically, Ghana pays its farmers through foreign financing. And the funding seems to be curtailed potentially because these loans are also backed by beans. So it's a bit of a chicken and egg situation, or cocoa and bean situation, if you want to put it that way. So that's why we're seeing the way that cocoa has surged past $9,000 a ton, jumping $700 in a single day at one point.
Yeah, that's right. And you know, when you take a look in terms of supply shortage, it's the worst in 40 years. You got to wonder what it means for the price direction. And for me in particular, you got to wonder what happens to my chocolate prices.
I think even as we head into Easter, that's been part of the conversation, right? How chocolate seems to be getting more expensive. There's the demand, there's the supply dynamic wrapped up in all of this. But as we talked about the supply dynamics, these are issues that don't seem to be going away very soon. So we seem to be headed into a third year of shortages. So Has, I think your chocolate is going to still stay quite expensive.
You're not getting a chocolate bunny this year, my friend. Avril Hong, thank you. Now let's get back to the Milken Institute Symposium underway in Hong Kong, where our own David Inglis is standing by with our next guest. Dave.
Yep, absolutely. The first ever, at least here in Hong Kong, Global Investment Symposium out of the Milken Institute. We've been having really a lot of in-depth conversations and quite, I wouldn't say unexpected, but certainly it's become front and center yet again in another Hong Kong conference. Private markets within that private credit. In fact, some of the guys here at Apollo that we had a couple of conferences back to stop by to say hi. Well, who better to talk about the conversation right now? Joining us here on set is Siddhartha Hari, Hillhouse LM Credit Partners co-head here joining us. Good morning. Nice to see you.
Morning, David, and thanks for having me.
I first want to give our viewers a taste of what you guys do, because your particular part of Hillhouse is a relatively new unit. How long have you guys, existed, for the lack of a better word?
So Hillhouse started this as a dedicated strategy about 9 months, 10 months ago with hiring me. And the reason for that were twofold. One, it was a desire for the firm to actually serve its entrepreneurs across the capital structure. Okay. So we've historically done public equity, private equity, growth and venture. As you know, we started real estate 3 years ago. The idea was also that there could be solutions relevant to our entrepreneurs in the slightly safer end of the capital structure, which is why LM Credit evolved, which means inspiration, by the way. So hopefully it's an inspired decision. And I think secondly also we felt that there was a clear white space for Asian-grown private credit managers that have an Asian-dedicated pool of capital to manage. So those are the two reasons we started this venture about 10 months ago.
Right. Does it feel crowded? New entrants like yourself.
Sure.
I wouldn't consider you guys new entrants. You've been in the industry for many years, but we have seen a lot of money get thrown into this in this direction.
For sure. I think there'd be pockets of any strategy that will always be crowded. So if I see Australia lending against private equity sponsors, that's a space, there's a lot of capital that's available. Some global funds are able to invest in that too because Australia is a developed market, fits the mandate. If you look at India, on some of the smaller transactions, there's been a lot of domestic money that's been raised where they can do tickets of $10 to $20 million equivalents.
Okay.
But as you go slightly larger, then again, there's a lot to grow in that space. So I think there are pockets that are crowded. But for us, we've always prided ourselves to be a solutions-driven business.
What does that mean?
And that means solving problems. And I'll give an example, right? Solving problems would mean an entrepreneur could come to us saying, this business is doing really well, but I promised my private equity partner, who's a minority stake in IPO, markets are not conducive, could you give me some money to buy them out? And that's really at the shareholder level.
Yeah.
That's one end of the spectrum, right? But I'm solving a problem for him where the private equity client of theirs might have needs that their fund life is finishing, or they could have other compulsions to exit. The founder doesn't think this is the best time or value for him to exit. So we give him money to buy out the private equity sponsor and give him more runway to IPO the business probably in 2 years down the run.
Right.
So that's one approach on a solutions-based business.
Running the risk of overgeneralizing, is the reason private credit is booming because almost nothing else is? And there's also a lot of money that
Sure.
that was raised as rates were going up. So the cost of capital for some of these funds, their hurdle rates are forcing them up the yield curve.
For sure. And I think there's a distinction here between Asia Pacific and the US.
Okay.
I think in the US, this is the mature market. Europe is probably 5 years behind the US, give or take. And Asia is still a virgin landscape,
Yeah.
right? Just to give you perspective, you've got almost 40% of GDP coming from the region, 30% of private equity, dry powder, and less than 10% of private credit. So I think there's, again, space to grow. Historically, there have been reasons why bank lending has dominated, and some of that has changed. Maybe we'll talk about that. But yeah, I think there's been a lot of capital that's been raised predominantly in the US on a very focused strategy, which is more LBO financings. I think in Asia, the capital that's been raised is, as I said, is more driven by either certain specific markets like Australia and India, and there are fewer pan-Asia players.
Okay. India's been a hot spot for you guys. What are you guys busy with there? And what are you looking at?
Sure. So we've actually closed a couple of transactions in India. Again, for confidentiality reasons, I can't talk about it.
Go ahead, no worries.
Your reporters do a great job actually in still figuring it out.
Okay.
So credit to them.
Yeah.
But I think, again, India, given the need for capital, I think we're seeing a lot of transactions. We've hired one senior person based in Mumbai just to make sure that we can service our clients on the ground. And the team that we've hired and put in place also has a lot of Indian experience, including myself. So yeah, India is absolutely going to be a key market, as would Australia, over the near term.
Are you sector specific or sector agnostic or somewhere in between?
I think fairly sector agnostic, but if you take a step back, the Hilo strategy has always been understanding and fundamental value-driven investing. So even if we are trying to do a new sector, the premise of this, even if it's a credit investment and we've got equity cushion behind us, would really be driven by what comfort can we derive, what value can we create, how much research can we do around the sector and its nuances.
And in terms of where we are in the cycle, we were talking during the break, where do you think we are in the cycle and running the risk of oversimplifying the rest of the region? And also the types of people that you look for, because for some, they haven't been in half a cycle.
For sure. And that is extremely important. Maybe I'd start with that first. I take actually immense pride in the team that we've built. We've hired 8 people externally, and we obviously get a lot of support from the Hill House platform itself on a lot of related functions. But the people that I chose to hire had one of 2 characteristics, probably both. One, they've seen cycles. So these are senior people who've been investing 15, 20 years, as have I, in this space. And that's a rare talent for a variety of reasons. But also, I think these are people who are somewhat multifaceted, so they can look at multiple geographies, multiple sectors. which gives us the ability to find relative value. So I'm not forced to invest in Australia if Australia gets suddenly very tight. There's a lot of capital chasing it. I can pivot to Australia, or I could pivot to India, I could pivot to Southeast Asia. So the ability of my team to be able to do that is extremely important for me.
Okay, so India, Australia, we've established that as a core part of your Asia strategy. Are you looking to enter other markets?
We are. So I think given our strength of the platform, China is always going to be important. I think there's clearly some demand-supply dynamics because of which the need for capital has reduced in China. Offshore capital has reduced in China. China is one of the only countries where rates have actually fallen. So a lot of financing has moved onshore. That would change as dollar rates come down back. So I think again, China is always going to be extremely relevant for us, and particularly more so with the kind of opportunity set that we see. And there's less people actively looking at the strategies. It does create, again, relative value for us.
Why do you think there's less attention right now to China? Is it the premium? Is it an understanding of the market? Is it all of the above?
I think it's a bit of everything.
Okay.
I think it's about understanding the market. It's about going deep. It's about understanding what your competitive positioning of particular sectors is. And that's hard if you don't have people on the ground. And again, I think like with the credit strategy, we've got people on the ground in Beijing, we've got people in Sydney, in Mumbai, as I talked about. I think having that connectivity with what's happening on the ground is extremely important when you're investing in this space. Because unlike private equity, here your returns are capped. At best, you'll get your money back plus interest.
Yeah.
And at the downside,
things go to plan.
If all things go to plan. And the downside case, you could lose a lot of money. So I think having that onshore connectivity, having that people on the ground who can evaluate risk and follow up post-closing the deal is extremely important.
Sid, you're based in Hong Kong, so we can talk again, hopefully sooner rather than later. Sid Hari there has, of course, out of Hill House, of course, LM Credit Partners co-head here. We could be here all day, but for now, back to you. Has.
David Engels, thank you so much for that. Of course, Dave been talking about the private credit market, the booming private credit market, anticipated to be at about $2.7 trillion by 2027. Well, still to come, Indian markets don't seem to be pricing in any surprises ahead of the general elections beginning next month. We discuss the risks. Keep it here with us. This is Bloomberg. Welcome back to Bloomberg Markets Asia, and we have breaking news. We have a story out of Bloomberg saying that Mahathir's son, saying that the 98-year-old father is a target of a Malaysian probe. The two eldest sons said Malaysia's anti-graft agency ordered them to assist with an investigation into their father, revealing for the first time that a months-long probe is targeting the 98-year-old former premier. Of course, we'll bring you the very latest and the details of that story just slightly later. India starts trading in about 2 minutes from here. We're just weeks away from the start of India's 6-week national elections, and the options market is suggesting traders are relatively unconcerned about any surprises. For more on what the data is showing, let's bring in equities reporter Chiranjeevi Chakraborty in Mumbai. CJ, are markets vulnerable to a nasty surprise?
Well, if you look at, going by the pricing and option market at this point of time, the consensus seems to be that the market is not. But when we know that, consensus can be wrong, and Indian markets have had a history around elections to be quite wrong. If you look at the past in 2004 and 2009, the consensus was one way and the market reacted in a completely different way out to the outcome surprise. So yes, it seems like there is some vulnerability because there seems to be a lot of focus, a lot of optimism around the election results, which may be in the market's favor.
But what could be the risk out there?
I think at this point of time, especially after the state elections that we had in some of the key states back in December, the outcome there was in the favor of the ruling, Bharatiya Janata Party, which kind of brought confidence to the market that probably, the Prime Minister Narendra Modi will get a third term that he's vying for. But at this point of time, the risk, of course, could be that the outcome may not be as strong as some of the market participants have been factoring in. You could always have, surprises in politics. Week is is a long time, and we are still at least 1.5 months away from the outcome. So we never know what may happen, and clearly the market at this point of time, according to some market participants, is not pricing in any sort of negative outcome or surprising outcome, which kind of leaves them, unprotected on the downside or to any large swings in the market, especially on the downside.
CJ, thank you so much for that. Equities reporter CJ Chakraborty. It has just started its trading day. It is in positive territory. Take a look where we are in terms of the benchmarks in the country. Pretty much green, red across the board in negative territory. Sensex down 0.2%, losses too for the Nifty 100. In terms of the rupee, let's take a look at the rupee right now. You were looking at the yuan actually on your board, but of course the rupee has been under a lot of pressure, falling to a record closing low just yesterday. We'll keep an eye on the currency. Of course, it is a strong dollar story. We're keeping an eye on that Indian rupee after its lowest ever close last Friday. The yuan slide weighed on the currency, and analysts expect this latest bout of weakness to trigger support from India's central bank. For more, let's bring in our FX and rate strategist, David Finnerty. David, is there cause for concern that the rupee is at such levels?
I wouldn't say at the moment. Basically, it's been range-bound for the last few months. Certainly this month it has been weakening. Some of that you said has been just basic dollar strength. Some of that you said it's been related to the yuan weakness, which we've seen. It's been caught up in that, as has other Asian currencies. Having said that, you're seeing the rupee slightly strengthen today as the yuan is stabilising. I think the next big risk really is the US PCE data coming out later this Friday. And remember, with Fed Chair Powell speaking later that day, if the data comes in strong and Powell sounds hawkish, then obviously the chance of US yields pushing higher rises. That will put more pressure on the rupee. But having said that, it does have the central bank, and India has plenty of reserves at 642 billion. So if it wants to defend that currency, which it has done previously, it more like has plenty of room to do so. So I wouldn't expect this to be the beginning of a big decline in the rupee.
Bear in mind, though, that India's on the verge of the bond inclusion. I mean, that rupee could recover its lost ground.
It certainly could. I mean, you've seen big inflows already this year of about 6.5 billion just into the bonds. So it's interesting is, despite those inflows, we've still seen the rupee in this range. So that is a sign of overall that, whether it be election jitters or just that general dollar strength, that the inflows have been supportive. But again, not supportive enough to really break out of the range from the rupee's side. But having said that, they definitely will be able to offset help offset any weakness that the rupee sees.
So in terms of stability, it is there, and we can bet a dollar that perhaps the RBI will ensure that as well, right?
Yeah, I think that's interesting. The RBI obviously meets next week, and we want to see how dovish or hawkish it sounds. Obviously, we saw Swiss National Bank last week surprise markets with this rate cut, and obviously we're looking at the Fed, ECB, Bank of England, all signalling rate cuts later this year. So the question is, how hawkish is the RBI? I think at the end of the day, said from the carry trade, it's always very appealing, and certainly if it remains in this range where stability, you look at implied volatility on the currency, it's very low. So certainly the markets aren't expecting the currency to break out, certainly to the downside anytime soon.
How about the election? Is it likely to have any impact on the currency?
I think because it's widely expected that Modi will win, obviously if that happens, then I think they'll be supportive. He's viewed as market positive. If somehow there was an upset, then markets don't like uncertainty. So I think that could potentially weigh slightly on the currency. But again, at the moment, the market's going, look, we really expect a Modi win. And therefore, it's sort of taken in its stride.
All right, David, thank you. Our FX and rate strategist, David Finnerty. Now, coming up, the founder of China's world-beating battery maker downplaying a global slowdown in EV sales growth. More from our interview with CATL chairman Robin Zeng. Next, this is Bloomberg. The founder of the world's biggest battery maker, CATL, says the company is pressing ahead with expansion despite a global slowdown in EV sales growth. In his first interview with an international news outlet since 2020, Robert Tseng told Bloomberg he is not worried about overcapacity and will crank up the output of more technologically advanced products. For more, let's bring in our Asia transport reporter, Linda Liu. Linda, put this in perspective for us. How can Tseng still be so positive about the growth of the global EV market?
Robinson just thinks that EVs are a really good product, and he's confident that the world will continue its transition to these zero emissions vehicles. These are sustainable, good for the environment, and just good products overall. And another factor is that Jen realizes that while China, the world's biggest EV market, is moving towards a market condition, the rest of the world's transition to EVs is still reliant on government mandates and policies, which is actually a good thing because these are hard demand that's going to really encourage customers and producers to continue to move towards EVs.
But there are lots of challenges, no? How is CATL navigating geopolitical tensions, the threat of the US IRA?
Yes, so CATL finds these geopolitics quite complicated. And for the US, they've had to take on this LRS model, which they call the royalty and services model, where they have this plant with Ford. Essentially, they will license battery making technology to Ford without having any of CATL's workers working there. So essentially, it's a technological transfer rather than more substantial input from the Chinese battery maker. And a big reason for going down this model is because of the IRA restrictions. But Zen was confident that, using this model, they can continue to compete in the US market.
And Linda, BYD set to release earnings later today, likely reporting record profits for 2023. What's in store for them this year?
Despite the record profits that many are expecting them to post today, it's actually looking very tough in the China EV market right now. BYD kicked off another round of price cuts, this time taking targets at conventional gasoline vehicles from Toyota and Volkswagen. And all of that is going to try to drive volumes, increase sales, but ultimately it could hit their bottom line as margins could suffer with all of these intense discounts on their cars.
And the EV price war continuing, has been going on for 2 years now. What's different with the latest round of cuts from BYD? Will it make a difference?
Yeah, these price cuts from BYD is really taking aim of conventional legacy automakers, some of the world's biggest, such as Toyota and Volkswagen, showing BYD's ambition that, they're looking beyond electric vehicle rivals such as Tesla. They are going to take on the bigwigs. And BYD latest products, even though they have really big discounts, still continue to pack a lot of technological features. So they think these are the products that's going to win over customers and really help them to keep growing.
Linda, thank you so much for those insights. Our Asia transport reporter, Linda Liu, as we've been talking about BYD set for earnings later. Let's do a check on how BYD stocks are doing at this point in time. We're also tracking Xiaomi. On the back of that, Xiaomi declared its ambition for its maiden SU7 to become one of China's 3 best-selling luxury electric vehicle models, sounding a challenge to Tesla and other rivals in an increasingly crowded market. Xiaomi up 0.8%, BYD up by 0.5% ahead of its earnings. Let's flip the page, take a look in terms of those currencies. We're looking at the yen at 151.42. 152 may be the level which we see intervention, but not at the moment. And in terms of the Aussie, 65.34 versus the USD. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. Do keep it here with us. This is Bloomberg.